The escalating conflict between the US and Iran is not only a geopolitical crisis, it also represents a classic negative supply shock to the global economy. Rising oil and gas prices, higher shipping and insurance costs, and increased geopolitical risk premia all feed directly into inflation while simultaneously weighing on global growth. That creates a difficult environment for policymakers, particularly central banks, which may face the uncomfortable trade-off between fighting inflation and supporting weakening economies. To unpack the macroeconomic consequences of this conflict, I'm joined today by Vincent Deluard, Director of Global Macro Strategy at StoneX. Thank you for joining us, Vincent.
Pleasure to be here.
First, Vincent, would you characterize the U.S. Iran conflict as a stagflationary shock for the global economy?
Yeah, I mean, that would be the exact definition of stagflation, right? I mean, it's an event that raises costs and really does not make anything better, right? I mean, we're just going to pay more for energy. It creates a lot of strain on global supply chains. There's also the military expense angle where, throwing missiles on each other and drones takes resources, and these resources are unproductive by definition. So whenever an economy pays more for energy and spends more on unproductive uses, that diverts resources from the economy, creates inflation, and that does not add any output. So yes, it's a perfect stagflationary shock. And it's very similar to what we experienced in the last period of major stagflation, was the 70s, when we had two oil shocks in short succession in the same geographical area.
And how significant is the inflation threat from higher oil and gas prices? And how quickly does that feed into broader price pressures?
Yeah, so the primary channel is this basically the crack spread, right? I mean, how when you turn oil into gasoline, so there is a relation over time. I mean, it's usually $1 increase in the price of Brent leads to a 25 cents increase at the pump in the US. So looking at, Brent at 80 today, coming off a low of 60, we had a $20 shock, which is actually not that high. I mean, in my opinion, could go higher. So that's about a 50 cent increase in gasoline, and that pass through is quite rapid. I mean, of course you have inventories and you have some, but you can always see gasoline prices increasing in the US. So 4 or 5 weeks. Now the question, of course, is typically these spikes in oil prices, energy prices tend to revert after a while. I mean, the global economy reconfigure itself. I mean, remember with a much larger shock after Russia's invasion of Ukraine, especially if you look at nat gas in Europe, and then eventually we found new suppliers, new routes. But in the very short term, yes, that's going to pass through, and that's something you start to see in March inflation number in the US, I would think.
And what does this mean for global growth, and which regions do you consider to be most vulnerable?
Well, so obviously actually, we don't know if it's a negative shock for growth. I mean, there is the argument that you can make that, fiscal stimulus is going to, wars, if you think in terms of nominal GDP, are usually pretty positive for growth. Now, it's not the good kind of growth, but GDP doesn't care, right? GDP just looks at the value of output that's being created. So whether we save life by, fixing cancer, or we create output by building bombs that would go and throw on each other, from the perspective of national accounting, it's all the same. So rather, let's think in terms of human happiness. It's not a happy event because it's not a good use of our resources. In terms of regions, about 20% of the world oil goes through the Strait of Hormuz, and it's kind of hard to replace because the other path is to go around if you look at the Arabian Peninsula, it's the Strait of Aden between Ethiopia and Yemen. Well, now we have the Houthis there, which are an Iranian-controlled proxy, and the flow of oil was also disturbed. So there's no very easy fix in terms of moving these barrels of oil. And these barrels primarily went to Asia. Europe is a little bit affected, but the biggest importers were the big Asian buyers. We've seen some damage on the Korean stock market, the Taiwanese stock market. Again, these are very energy intensive and energy dependent countries. China is also a big buyer, but they've done a better job of kind of diversifying the supply, getting more from land, and also building inventories. So I would say for now, the biggest losers are the energy-dependent Asian economies that had very low inventories and that cannot easily switch supply. So that would be your. Sorry, let me just to restate. That would be your India, Taiwan, and South Korea.
And how does this complicate the central bank's policies, I think particularly looking at the Federal Reserve here?
Yeah, I mean, stagflationary shocks are what the nightmare of central bankers, right? Because the Fed, but most central bankers have a dual mandate, where it posits the existence of this trade-off between inflation and unemployment rate, and you kind of constantly optimizing these two functions based on the supposition that they, high inflation leads to low unemployment and vice versa. Now, the stagflationary shock moves inflation while it reduces output. So both of the things that you're trying to keep low are moving higher, and there is no good solution. In the U.S., the equation is kind of complicated by the fact that the Fed was under attack from the president, and that we have a new Fed chairman that is untested, so we can't kind of look back historically. And I think that's probably the more likely outcome. Central banks tend to have a wait-and-see approach to stagflationary shock, because when all your options are bad, the best is to do nothing. So you don't want to. I mean, there is a shock to inflation that will make you raise rates, but it's not clear that raising rates will produce more oil. That actually rarely happens that way. So you don't want to raise rates. But at the same time, you really can't cut when inflation is going up. So I think the most likely outcome is that pause that started a couple of months ago will continue longer than the market thought just a month ago.
Now, you briefly touched on this, but the Fed also faces the added political dimension with the potential changes in Fed leadership and ongoing pressures from the White House. How does that factor into the policy outlook?
Yeah, I think it adds to uncertainties. Whenever you have someone that's untested, the market doesn't like it and likes to test. I mean, if you think pretty much all the recent central bankers were met with a significant market volatility. I mean, you can think. I think Greenspan started around the '89 crash. Bernanke had the '08 crisis. So that's especially relevant for someone like Kevin Walsh, who has a history of kind of being this out of the box, sometimes a heterodox thinker. So the market was already kind of wondering what a Walsh central bank would look like, given the fact that also he has a history of being quite critical of the board. In the most immediate sense, it really reduces the odds of a rate cut, because the case that Walsh had made for cutting rates, which was already flimsy to start with, it was the idea that by shrinking the balance sheet, that was kind of tightening policy, so he could offset that with rate cuts to maintain a neutral level. That was very flimsy. And then the other flimsy argument was this massive productivity shock that AI was going to unleash. Well, if at the same time we have a stagflationary shock from higher oil prices, and that we have a significantly higher government expense because we have to finance a long overseas war, that's going to make shrinking the Fed's balance sheet much harder. So the theoretical case for rate cuts, I think, has suffered quite a bit from these geopolitical developments.
And finally, Vincent, if the conflict does prove to be prolonged, could we expect a structural shift towards a more volatile and inflation-prone global economy?
I mean, I wouldn't say it's a shift because, in my opinion, we've been there since at least 2020. That's the case that we've made across many podcasts and all the report that we have this new era, where growth, volatility, rates, and inflation is structurally higher because the geopolitical order is splintering, because global trade is harder, and that's, I mean, obviously that's a big one, right? We're talking about really beating hard the global economy, 20% of world oil flow, a bit more when it comes to nat gas. So that makes everything more difficult. Yeah, I mean, the lesson that everybody takes from this is inventories and supplies. Now you could see the countries that prepared. I remember last year everybody was wondering why was China stockpiling on oil. Well, now we see the strategic value of having your inventories of whether it's oil, nat gas, copper. So as everybody reacts in the same way, that adds to this friction to the global economy, that adds to tensions on commodity prices, and that means that we're resetting indeed to a world of higher inflation and generally a less efficient world than what we're used to.
Well, thank you once again for your insights, Vincent. Great to catch up.
Pleasure to be here.
For more videos like this, please do like and subscribe.